Hello, my name is David Batchelor and welcome to this BDNI session for Solidence licensees. About 10 years ago, I put together a study group for advisors where we talk about the issues of the day, talk about good old-fashioned sales and talk about how to improve our practices. And today, I want to spend a little bit of time with you talking about the Asset Preservation Trust and how that should be considered post the April 2015 changes in pension rules. Now, most of you probably understand what the Asset Preservation Trust is, and most of you understand that the Asset Preservation Trust is effectively Solidus's version of the Spousal Bypass Trust. But what many people don't realise is the advantages of the Asset Preservation Trust over a simple Spousal Bypass Trust. There's been so much in the media of how a Spousal Bypass Trust is no longer needed that it misses some of the key points. And whilst there are many differences between an Asset Preservation Trust to the Spousal Bypass Trust, the key three are firstly that from an Asset Preservation Trust the beneficiaries can take loans from the trust rather than simple dispersals. Few Spousal Bypass Trusts allow this feature. The second point is that the Asset Preservation Trust lasts for 125 years. Most Spousal Bypass Trusts, certainly ones provided by the insurance companies, are limited to a 2-year period. And when we look at the Asset Preservation Trust, we want to use it as a multi-generational planning tool. Lastly, with the Asset Preservation Trust, it can hold multiple assets. This means that you can hold not just the client's pension benefits, but also their death in service benefits. This is hugely valuable as it means that if a client has different pensions from different providers, from a different employer, and different death in service benefits, then these can all be held in a single trust, making the job of the trustees and the beneficiaries of the estates much more simple. So let's take a look at what I'm going to talk about today. I'm going to talk about the general principles of the Asset Preservation Trust and talk about how these reflect on things prior to age 75 and then post age 75. Then we're going to take a look at what happens actually on death and how this influences the way that things should be done. So if we think about the Asset Preservation Trust, the first thing is to understand that there are significant advantages firstly to the client, and this is what we must think of all the time. And those really revolve around the idea of certainty. Using the Asset Preservation Trust means that the client can be certain as to what's going to happen to his hard-earned money that's in his pension fund. When he uses the Asset Preservation Trust, it also means that the assets can be passed down via multiple generations. Because of its ability to last 125 years, it means that assets held within it can be passed down through many generations. This also means it saves a huge amount of intergenerational inheritance tax planning, a point which is often forgotten. If you receive the benefits of a pension and it falls into your estate, when you then pass it down to your children, then because it's part of your estate, there's going to be some inheritance tax payable. So the Asset Preservation Trust allows the multiple generation planning to be put into the whole part of the cash flow analysis when you're dealing with a client. It allows you to protect what we call the toy boy syndrome. This is where if a husband or a wife passes away and the assets go to the surviving spouse and they remarry, that it's the new spouse which has access to the money. Then we also have that other thing which so many clients seem to be concerned about, and that's a daughter-in-law from hell. We want to make sure that the money goes to the right person at the right time and not suddenly to that daughter-in-law who perhaps might have divorced a son, causing some form of separation of the assets. And lastly, from the client's point of view, I think the Asset Preservation Trust is stunningly good value. In our practice, we have a minimum charge of £900 for the Asset Preservation Trust, plus an additional fee for assets which are added to it. But if you think that our average pension client has a pension of about $560,000, that's a tiny amount to pay to protect such a large asset. Imagine paying, say, £1,500 as an average to protect an asset that's worth $500,000. That's stunningly good value in anybody's book. Now, from our point of view as practitioners, our point of view as advisors, use of the Asset Preservation Trust also has some significant advantages. The first of which, of course, is that you're giving independent legal advice to the client. So often, if you use a standard bypass trust, it will make a note on it that they should seek independent legal advice. And because of the way in which ours are provided, you already provide that independent legal advice. It produces extra income to your practice. And let's not deny this is why we're in business. Yes, we want to help clients and we want to make their lives better, but at the same time we have to generate income. If we don't generate income, we won't be around in the future to help them. So this is a hugely important point which for some reason is continuously overlooked. It's also a non-regulated product. This makes life a lot more simple. And if you set your businesses up with a regulated and non-regulated part, this is something that goes through the non-regulated section, which makes the whole implementation process much more simple. It can also be used to generate referrals. We make it a process to meet with all of the trustees which are going to be on all of the asset preservation trusts, and this gives us a huge opportunity to access them for referrals. It also makes you unique. So many people still don't do any form of involved and complex planning. And whilst I don't think that the Asset Preservation Trust is particularly complex, for most people they just don't get around to doing it, often because they can't see the value themselves. And lastly, it helps you ring-fence the client. If you're looking after their legal needs as well as their financial planning needs, it means that they're not going to go to anybody else. So with all these advantages for the client and all these advantages for yourself, then how should the Asset Preservation Trust be used and where it fits in with the standard planning process? And let's ignore any changes in legislation for the time being. Let's just understand basically how an Asset Preservation Trust works. So in this case, this terribly sexist case of the man who has a pension fund, we're going to assume that he's got a wife and he wants to pass the assets to his wife. The wife then, when she dies, will want to pass the assets down to the children. So in this particular case, this chap's got a pension and death in service benefits. So his pension will be worth whatever it's worth, and he also has some death in service benefits. In the event of his death, he wants to pass those to his wife. This will allow her to live on those assets when she receives them. When the assets are passed to the spouse, then these are usually outside of the estate, and so there is no need for probate to be granted, because usually the pension and death in service benefits will be passed by the trustees. So the money within the pension and death in service will be passed to the spouse. She will use those assets or spend them, whatever she decides to do. In the event of her death, she wants to pass them down to the children. Now this is where we start to have an issue, because if she receives the benefits of the pension, let's say that's £300,000, and let's say there's also £200,000 of death in service, she has received £500,000 in cash. That's £500,000 which is added to her estate, which wasn't there to start off with. So often people say there's no tax on pensions, and they're right, that when money's paid out of the pension, there is no tax. But once she's received that money from the pension provider, it's then in her estate. This means that when those assets pass down to the children, that it will be added to the estate and be calculable for inheritance tax. In this particular case, if there was £300,000 of pension and £200,000 of death in service benefits, that means there could potentially be £200,000 of inheritance tax, simply because in the spouse's estate you wouldn't have taken account of the value of that pension. I guess there's another point, and that is what happens if she remarries. Imagine that she's received this £500,000 from his estate and then she remarries. All of a sudden, her new partner, her new husband, her new spouse has access to that money. Certainly if they decide to get divorced at some point in the future. If she dies before him, well, he's certainly going to have access to them. And it's these issues that the Asset Preservation Trust is designed to protect and avoid. Imagine a situation where you have an Asset Preservation Trust and that is the beneficiary of the pension and death in service benefits. That means that these assets pass into the Asset Preservation Trust. As I've said before, once the money falls into the Asset Preservation Trust, then the spouse is going to access that money by way of a loan. She will borrow the money from the Asset Preservation Trust, not disperse it, but borrow the money. This means that there is a debt on her estate. It means that the money is not included in her estate when she dies. And here's the important point. It's not in her estate. So in the event of her death, then that money must fall back to the Asset Preservation Trust and then pass to the children. Because it didn't pass directly from her to the children, there is no inheritance tax. And of course, if the children then pass this down again to their children, providing they've taken the money from the Asset Preservation Trust as a loan, it protects money again. Then of course there's something that's probably for most people even more important, and that is the fact that it ring-fences the money from third-party claims. Now it might be something as simple as avoiding the local authority getting hold of the pension money. But in this particular case we're talking about protecting the assets from her new spouse, as well as protecting those assets from the inheritance tax which could be payable. So this is how an Asset Preservation Trust has always worked, and not much has changed with the new rules. It's just a question of understanding how do we deal with things with the person being prior to 75 and 75 and over, because this is the fundamental difference in pensions legislation which is affected by the Asset Preservation Trust. And the first thing to do is to celebrate And that's because if a person is under 75, then the benefits of the Asset Preservation Trust are even greater. Previously, the assets from the Asset Preservation Trust would typically only fall into the Asset Preservation Trust if the assets were not crystallised. Now, even if the pension is crystallised, it can still fall into the Asset Preservation Trust. This is a huge benefit to the client. If you're under 74, it means that the proceeds will pass as cash or a pension, and with both of those being passed down totally tax-free. Neither the cash nor pension will be taxed. Now the problem with this, as I've already said, is there's potentially inheritance tax payable. You have the issue of a toy boy, and then there could even be the daughter-in-law from hell that's going to get involved. With the Asset Preservation Trust, it protects whatever's passed down in the form of cash from inheritance tax, from any toy boys, or indeed from the daughter-in-law from hell. So we must then conclude that anybody that's aged 74 and under absolutely should have an Asset Preservation Trust. There's no reason for them not to have it. And as most people take out the Asset Preservation Trust much younger than age 75, it means that most of our clients will actually have this asset and have this trust to protect their pensions and death in service benefits. The bigger question for most people, and I think this is one of the things that has been causing some form of smokescreen and stopping people making a decision, is what happens if you're 75 and over. Well, as all of you know, in the event of someone passing away and are aged over 75, whether their pension is crystallised or not, they can either take it as a pension. Now, if they take it as a pension, that means that the benefits, when the beneficiaries take those benefits, will be charged based on their marginal rate tax. So the pension will become their pension, and as they take the benefits, then they're going to be charged based on their marginal rate tax. If they take the cash out of the pension, instead of converting it into their pension, they're presently going to pay a 45% tax charge. Now, we believe this is going to change shortly, but at the moment 45% tax is what they're going to be paying if they take it out as cash. Now, of course, if the money comes out as cash, that can be passed into the Asset Preservation Trust and provide protection to the money. If the money goes to the beneficiary as a pension, then it falls into their estate and then can be at danger from third-party claims. So let's take a look at those two alternatives. First of all, imagine that they take the money out of the pension as cash, and that would pass into the Asset Preservation Trust. If the client's got 3 children, then it would be passed down to them via loans in the normal way. This means that the amount that they receive from the pension, whilst it will have had tax deducted, at this point when it passes from the Asset Preservation Trust down to them, there's no more tax deduction. It's a loan to them. And as it's a loan, it then ring fences them from any form of third-party claims and provides protection all round. It gives a huge amount of certainty, and of course it avoids any inheritance tax liability because it's passing via a loan through the Asset Preservation Trust. If they'd taken the pension money just as simple cash and put it into their estate, then when they die, inheritance tax is going to be payable. Much better when that money comes out as cash to pass it into the Asset Preservation Trust and for them to take loans from the trust. And of course it provides much greater flexibility. If the money is in a pension, then you're always going to be restricted by whatever the pension rules are at the moment. And recently, the pension rules have been made much more flexible so that people can do pretty much whatever they want to do with pensions. But no one knows if that's going to be the case in the future. And because we don't know what the future will hold, sometimes this greater flexibility is hugely important to clients. Of course, what we've got to accept is that probably more tax will be paid. If the money post-75 goes into an Asset Preservation Trust, there's probably going to be more tax paid here, because almost certainly the amount that passes will push the beneficiaries into higher rate tax, and in some cases it might push them up to 45% tax. So probably there will be a higher tax to be paid. Now the alternative is to take the money from the pension and pass it through to the beneficiaries, but by passing it directly into their own pensions, which of course is what the new rules allow you to do. So if you were to pass away and you have children, you can pass it to them as their pension. Now that has advantages and disadvantages. First advantage is of course that it's probably lower tax than if you took it all in one go. No, it doesn't mean it's going to be lower tax, because if you're a high rate taxpayer here, then what's the difference? If you're going to be a high rate taxpayer in retirement, well, why not pass money into the Asset Preservation Trust, pay the high rate tax now and have done with it? Also, it means that taxation rates may increase in the future. Of course, they may decrease as well. But if you want some certainty, then you do have the situation of knowing that paying the tax now might provide you with that. Now, if you pass the money through to the beneficiary's pensions, the first issue is third-party claims. Now, what I mean by that is, imagine you pass the money through into your child's pension and your child then gets divorced. A pension is included on the Form E when you calculate the share that has to be passed during a divorce settlement. That means the pension that they inherit from the parent will be included in the divorce settlement. If, however, the money passes via an asset preservation trust, it's not included in the children's divorce settlement. So by passing via the asset preservation trust will protect the money that came from the pension from third-party claims. If the assets are passed into a pension of the beneficiary, then third-party claims can be made. Secondly, when you pass assets through the pension, it can cause a future inheritance tax liability. Well, how does that happen, you say? Well, imagine the money goes into the beneficiary's pension and they decide to cash it all in. We all know lots of our clients and our clients' children, and I can think of a great number of my clients' children that would immediately cash all the money in. If they do that, it's going to fall straight into their estate, so when they die, then it's going to be added to the value of their estate and inheritance tax is going to be payable. Lastly, we really don't know what the pension rules are going to be in the future. Yes, they're incredibly flexible at the moment, but we all know that changes will be made in the future, we just don't know what they are. So the danger is you have this issue of pension rule changes, so we really don't know. I think the most important point here to remember with all of these issues is that the money post-death is outside of the estate if it falls into an asset preservation trust and the proceeds passed down by way of a loan. This gives a huge amount of flexibility to the client. And whether or not money passes into the asset preservation trust post-75 or passes directly as a pension is really a choice of the trustee. It's not something that the client decides at this point, it's a choice of the trustee. And what we're doing with the use of an asset preservation trust is effectively giving the trustees flexibility in the future. If there's no asset preservation trust, there's no flexibility. But if there is, there's a huge amount of flexibility. So really, from the point of view of whether or not you should implement the asset preservation trust, for most people, it's going to come down to a case of trying to weigh up the costs and the benefits. Is it worth paying that extra bit of tax in the future to provide certainty and protect the pension or not? Well, the thing is, that's not our decision, it's the client's decision. And more importantly than that, it's probably not the client's decision, it's probably their beneficiary's decision, because they're going to inherit when our clients have passed away. So the most important point, and this is the thing which I would really like you to think about, is that it should be the trustee's choice as to what happens. This is not your decision as an advisor. It's not your decision to decide whether or not the client should have an asset preservation trust. It's your job to advise what the client should do, and then they will do whatever they want to do. As far as I can see, I can't see any reason why you wouldn't advise on putting an asset preservation trust in place simply because of the flexibility that this gives to the clients. So I hope this session on the Asset Preservation Trust and the impacts of the legislation changes in April 2015 has helped. I hope it gives you some idea as to how to discuss things with clients and perhaps has given you some ideas of how to sell things to them directly. In future sessions we're going to cover another trust, in particular the Assurance Trust and Beneficiary Protection Trust. But if you'd like to take a look at things which are not trust related, then please go to our website. In fact, click this link and take a look at some of the other training that we put in place. I'm sure some of this will really help you in your practice. So thanks very much for listening, and I'll speak to you again in the future.